You know what's fascinating about market panics? They don't announce themselves with sirens and flashing lights. They creep up slowly, building pressure beneath the surface until one day, boom, everything changes overnight. And right now, we're watching that exact scenario unfold in the silver market, except this time it's not just one country or one sector. This squeeze has gone global, and the implications are staggering. Let me paint you a picture of what's actually happening right now. For 5 consecutive years, the silver market has been running a structural deficit. Think about that for a second. 5 years. That means for half a decade, the world has been consuming more silver than it produces. Every single year. And it's not slowing down, it's accelerating. The numbers tell a story that most people aren't paying attention to. Global silver demand is sitting at over 1.1 billion ounces annually. Meanwhile, production? It's struggling to keep pace. We're talking about a market that's been bleeding inventory for years, and now the pressure is reaching a critical point. But here's where it gets really interesting. This isn't your grandfather's silver squeeze. Back in the day, silver demand was primarily driven by investment in jewelry. Simple stuff. Today, silver has become absolutely critical to the technologies that define modern life. And that's where the real story begins. Solar panels, electric vehicles, 5G infrastructure, consumer electronics, medical devices. Every single one of these industries is consuming silver at unprecedented rates, and they're not slowing down. In fact, they're ramping up production like never before. Let's talk about solar for a moment, because this is where things get wild. Photovoltaic demand for silver just hit another record. We're in the middle of a global energy transition, and silver is at the heart of it. Every solar panel requires silver paste for its electrical conductivity. There's no substitute that works as well. And governments around the world are mandating renewable energy targets that require billions of solar panels to be manufactured over the next decade. Think about China alone. They're installing solar capacity at a pace that would have seemed impossible just a few years ago. Europe is racing to reduce dependence on Russian energy. The United States is pouring hundreds of billions into green energy infrastructure, and every single solar panel they install pulls physical silver out of the available supply permanently. But solar is just one piece of the puzzle. Electric vehicles are the other massive demand driver that's reshaping this market. Every EV requires significantly more silver than a traditional combustion engine vehicle. We're talking about silver in the electrical systems, the charging infrastructure, the battery management systems, and the automotive industry is going all in on electrification. Major automakers have announced plans to phase out combustion engines entirely within the next decade or two. That means hundreds of millions of vehicles will need to be manufactured with significantly higher silver content. The math is simple but staggering. As EV adoption accelerates, silver demand from the automotive sector is going to explode. Now you might be thinking, okay, demand is high, but can't they just mine more silver? And that's the question that reveals just how precarious this situation really is. Silver mining is not like flipping a switch. You can't just decide to produce more silver tomorrow. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver production is largely dependent on the economics of those other metals. If copper prices drop, copper mines slow down, and silver production drops with it, regardless of how high silver prices go. The primary silver mines that do exist, many of them are mature operations with declining ore grades. They're pulling silver out of the ground, but each year it gets harder and more expensive. New discoveries are rare. Permitting and developing new mines takes years, sometimes decades. There's no quick fix to ramp up supply. And here's the kicker. Even if mining companies wanted to dramatically increase production, the environmental and regulatory hurdles are massive. Communities don't want new mines in their backyards. Governments are imposing stricter environmental standards. The timeline from discovery to production for a new silver mine can easily stretch beyond 10 years. So we have surging demand from industries that are critical to the future economy, and we have supply that's essentially stuck. That's the recipe for a squeeze. But it gets even more interesting when you look at what's happening in the investment world. Central banks have been on a gold buying spree for years now, and that's well documented. But what's flying under the radar is how institutional investors are starting to wake up to silver. They're looking at the same supply-demand fundamentals we're discussing, and they're realizing that silver is dramatically undervalued relative to its industrial importance and scarcity. Exchange-traded funds backed by physical silver have been seeing steady inflows. That means real metal is being pulled off the market and locked away in vaults. Every ounce that goes into an ETF is one less ounce available for industrial users who actually need it to manufacture products. And then there's the retail investment surge. Remember the social media-driven silver squeeze attempts? While those didn't break the market like some hoped, they did something important. They woke up millions of regular people to the silver story. Now you have a growing base of individual investors who are buying physical silver coins and bars, further tightening the available supply. Let me tell you about something that doesn't get enough attention: the COMEX warehouse dynamics. The COMEX is where silver futures are traded, and it's supposed to have physical silver backing those paper contracts. But the ratio of paper claims to physical metal has been growing. There are far more contracts representing silver than there is actual silver sitting in the warehouses. This creates a fascinating situation, as long as most contract holders settle in cash rather than demanding physical delivery. The system works. But what happens when industrial users start demanding physical delivery because they can't source silver anywhere else? What happens when investors lose faith in paper claims and want the real metal? We've seen glimpses of stress in this system. There have been moments when the spreads between paper and physical silver widened dramatically. Times when premiums on physical coins and bars spiked because dealers couldn't source enough metal. These are warning signs of a system under pressure. Now, let's zoom out and look at the geopolitical dimension, because this is where the silver story intersects with much bigger trends reshaping the global economy. We're living through a period of de-dollarization. Countries around the world are reducing their dependence on the US dollar for trade and reserves. They're looking for alternatives, and precious metals are part of that equation. While gold gets most of the attention, silver is increasingly being viewed as a monetary metal with industrial utility, the best of both worlds. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been expanding their alliance and discussing alternatives to dollar-dominated trade. These countries represent a massive portion of global economic activity, and they're all significant consumers of silver for industrial purposes. If they start accumulating silver as part of a broader strategy to diversify away from dollar assets, that's another major source of demand hitting a market that's already tight. Then there's the trade war dynamics. Tariffs and trade restrictions are reshaping global supply chains. Silver mining and refining capacity is concentrated in certain regions. If geopolitical tensions lead to export restrictions or supply chain disruptions, the squeeze intensifies. China, for example, is both a major producer and consumer of silver. If they decided to restrict exports to secure domestic supply for their own industrial needs, that would send shockwaves through global markets. It's not a far-fetched scenario. We've seen China implement export controls on other critical materials. Let me take you back in history for a moment, because understanding past silver markets helps us see where this could be headed. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions, and silver prices skyrocketed from around $5 an ounce to over $50 in a matter of months. Now, their attempt ultimately failed due to regulatory intervention and margin changes, but it demonstrated something important. Silver markets can move violently when supply gets tight and concentrated buying emerges. Fast forward to 2011. Silver hit nearly $50 an ounce again during the aftermath of the financial crisis. Investors were fleeing to hard assets, industrial demand was recovering, and supply was constrained. The price surge was dramatic and swift. But here's what's different about today's situation. In 1980, the squeeze was driven by speculation and manipulation. In 2011, it was largely an investment-driven rally. Today, we have genuine structural deficits driven by irreplaceable industrial demand. This isn't speculation, it's fundamental supply and demand economics playing out in real time. The solar industry can't function without silver. EV manufacturers can't build their vehicles without it. Electronics companies can't produce smartphones and computers without it. This demand is not optional. It's not going away if prices rise. These industries will pay whatever they have to pay to secure the silver they need. And that's what makes this squeeze different and potentially more powerful than anything we've seen before. When industrial users compete with investors for a shrinking pool of available metal, prices can move in ways that shock people. Let me share something that might be relevant to your situation. If you're sitting on retirement accounts, maybe you've got $100,000 or more in a 401k or IRA, there's a way to position yourself in physical precious metals without triggering tax penalties. I put together a free guide on how gold IRAs work, covering the mechanics of getting physical gold into your retirement account. It's in the description if that's something you want to explore. Just a resource that might be helpful given what we're discussing. But back to the silver market dynamics, because there's another layer to this that's absolutely critical to understand: the paper versus physical disconnect. In the modern financial system, most silver trading happens on paper. Futures contracts, options, ETFs that don't hold physical metal, certificates, allocated accounts. These paper instruments allow for massive leverage and speculation. You can control far more silver on paper than actually exists in physical form. This works fine in normal markets. But when physical demand surges and supply tightens, the paper market can become disconnected from physical reality. We've seen this happen in other commodities. When everyone wants physical delivery at the same time, the system breaks down. Imagine you're an industrial manufacturer, and you need silver to keep your production line running. You've been buying futures contracts to hedge your needs. But when you go to take delivery, you're told there's a delay. Or you're offered a cash settlement instead. Or the premium for physical delivery has spiked to levels that make your contracts worthless. This is the nightmare scenario that keeps supply chain managers awake at night. And it's becoming more plausible as the structural deficit persists. The London Bullion Market Association, which oversees the professional bullion market, has reported declining silver inventories in their vaults. These are the stockpiles that are supposed to buffer supply and demand imbalances. When those inventories drop, the market becomes more volatile and prone to squeezes. Now let's talk about what happens to prices when a true supply squeeze hits a market like silver. In commodities with tight supplies, prices don't move in straight lines. They can gap violently. You might see silver trading at $30 one day and $40 the next, with no trades in between. This happens because when physical metal becomes scarce, buyers become desperate and sellers become reluctant. Industrial users who need silver to keep factories running will pay almost any price rather than shut down production. That's not hyperbole, it's basic business economics. If you're a solar panel manufacturer with billions in contracts and your production line stops because you can't source silver, you'll pay a massive premium to get the metal you need. And once prices start moving, momentum builds. Investors who were sitting on the sidelines see the price action and jump in, not wanting to miss the move. Short sellers who bet against silver get squeezed and have to cover their positions, buying silver at any price to close out their losing trades. This creates a feedback loop that can drive prices far higher than anyone expected. We've seen this pattern in other commodities. Palladium went from a few $100s an ounce to over $3,000 during a supply squeeze driven by automotive demand. Rhodium spiked to over $30,000 an ounce when supply couldn't keep up with catalytic converter needs. Silver has the same potential because the fundamental dynamics are similar. Inelastic industrial demand meeting constrained supply. But here's what makes silver even more interesting than those other metals. Silver has a monetary history. For thousands of years, silver was money. It's still recognized as a store of value. When financial systems come under stress, people instinctively turn to silver and gold. We're living in a time of unprecedented monetary expansion. Central banks have printed trillions in new currency. Government debts are at levels that would have been unthinkable a generation ago. Inflation has eroded purchasing power. In this environment, hard assets with intrinsic value become increasingly attractive. Silver sits at the intersection of industrial necessity and monetary value. It's needed for the technologies of the future, and it's a hedge against monetary instability. That dual demand profile is incredibly powerful. Let me walk you through what a full-blown silver squeeze might look like, because understanding the mechanics helps you see why this matters. Stage 1 is what we're seeing now: persistent structural deficits that slowly drain inventories. Prices rise gradually as the market tightens, but most people don't notice because the moves are relatively modest. Stage 2 begins when industrial users start having trouble sourcing metal. Lead times extend. Premiums for physical delivery increase. Some manufacturers start building larger inventories as a buffer, which ironically makes the shortage worse by pulling more metal off the market. Stage 3 is when the paper market starts to crack. Futures contracts trade at significant discounts to physical metal because holders don't trust they can get delivery. ETFs that claim to hold silver face redemption pressures as investors demand proof of physical backing. The COMEX might implement delivery restrictions or force cash settlements. Stage 4 is the full squeeze. Prices spike violently as industrial users compete desperately for available supply. Mining companies can't ramp up production fast enough. Recycling increases but can't fill the gap. Governments might even consider strategic stockpiling or export restrictions, which makes the global shortage worse. We're somewhere between Stage 1 and Stage 2 right now. The question isn't whether we'll move to Stage 3, it's when. And here's the thing that most people miss. Once a squeeze starts, it feeds on itself. Higher prices don't immediately bring more supply because of the long lead times in mining, but higher prices do bring more investment demand as people chase the momentum. This creates a gap that can take years to resolve. Look at what happened with lithium. When EV demand surged, lithium prices went parabolic because supply couldn't keep up. Mining companies announced new projects, but those projects take years to come online. In the meantime, prices stayed elevated and volatile. Silver is facing the same dynamic, except the supply constraints are even more severe because most silver is a byproduct of other mining operations. You can't just decide to mine more silver. You have to mine more copper or zinc or lead, and those markets have their own supply-demand dynamics. The solar industry alone is projected to consume record amounts of silver over the next decade. The International Energy Agency forecasts massive growth in solar installations to meet climate goals. Every gigawatt of solar capacity requires tons of silver. Multiply that across the global build-out, and you're talking about demand that dwarfs anything we've seen historically. Electric vehicles are following a similar trajectory. Governments are mandating EV adoption. Automakers are investing hundreds of billions in electrification. The infrastructure to support EVs, charging stations, grid upgrades, battery production, all requires silver. This demand is locked in by policy and corporate strategy. It's not going away. Then, layer on top of that the electronics industry, which continues to grow as more of the world comes online. Smartphones, computers, servers, IoT devices all require silver. 5G networks need silver in their infrastructure. Data centers need silver in their equipment. The digital economy runs on silver. And we haven't even talked about traditional demand from jewelry, silverware, and photography, which still accounts for significant consumption, even though it's declined from historical levels. When you add up all these demand sources and compare them to available supply, the math is stark. The deficit isn't a temporary blip. It's a structural feature of the market that's likely to persist for years. Now, some people will argue that higher prices will solve the problem by incentivizing more production and reducing demand. That's basic economics, right? But in silver's case, both sides of that equation are sticky. On the supply side, as we've discussed, production can't ramp up quickly. Even with higher prices, it takes years to bring new mines online. And because most silver is a byproduct, silver prices alone don't determine production levels. On the demand side, industrial users have limited ability to reduce consumption. You can't make a solar panel work with less silver. The physics don't allow it. You can't build an EV with less silver without compromising performance. These are technical requirements, not preferences. Sure, at extremely high prices, some substitution might occur. Researchers might develop alternative materials, but that takes time. And in the meantime, manufacturers need silver to keep operating. This is what creates the potential for a sustained price surge rather than a brief spike. The market can't quickly rebalance because both supply and demand are relatively inelastic in the short to medium term. Let's talk about what this means for different groups of people, because the implications vary depending on your situation. If you're an investor, silver represents an asymmetric opportunity. The downside is relatively limited. Silver has industrial value and monetary value that provides a floor. But the upside in a squeeze scenario is substantial. We're talking about potential multiples of the current price if the supply situation deteriorates further. If you're someone concerned about wealth preservation, silver offers a tangible asset that's not dependent on the financial system. Unlike stocks or bonds, physical silver can't be inflated away or defaulted on. It's real wealth that you can hold in your hand. If you're thinking about retirement security, having some exposure to precious metals can provide diversification and protection against monetary instability. The traditional 60-40 stock-bond portfolio doesn't account for the kind of structural changes we're seeing in the global economy. But here's what's crucial to understand. Timing matters in markets like this. Once a squeeze is obvious to everyone, the easy gains are gone. The people who benefit most are those who position themselves before the crowd realizes what's happening. Right now, we're in that window where the fundamentals are clear to anyone paying attention, but the broader market hasn't fully priced in the implications. Silver is still trading at levels that seem almost quaint given the supply-demand dynamics. Think about it this way. If you knew with certainty that a critical industrial metal was going to be in severe shortage within the next few years, and that shortage would drive prices dramatically higher, what would you do? You'd want to own that metal before the shortage became acute. That's the situation we're looking at with silver. The structural deficit is real. The demand drivers are accelerating. The supply constraints are binding. The only question is how long it takes for the market to fully recognize and price in these realities. And here's the thing about market recognition. It doesn't happen gradually. It happens in bursts. One day, a major industrial user announces they're having trouble sourcing silver, or a prominent investor releases a report highlighting the supply deficit, or a geopolitical event disrupts supply chains, and suddenly everyone is paying attention at once. When that moment comes, prices can move faster than most people can react. We've seen it happen in other markets. The people who benefit are those who did their homework and positioned themselves in advance. Now, I want to be clear about something. I'm not saying silver is going to the moon tomorrow. Markets are complex, and there are always factors that can delay or alter expected outcomes. What I am saying is that the fundamental setup for a significant silver squeeze is in place and the risk-reward profile is compelling. The global nature of this squeeze is what makes it particularly significant. This isn't isolated to one country or one sector. It's a worldwide phenomenon driven by megatrends that are reshaping the global economy, the energy transition, electrification of transportation, digitalization, and monetary instability. These trends are not reversible in the short term. Governments have committed to them through policy. Corporations have committed to them through capital allocation. Consumers are demanding them through their choices. The silver demand that results from these trends is as close to certain as anything gets in economics. Meanwhile, the supply side remains constrained by geology, economics, and time. You can't wish new silver deposits into existence. You can't fast-forward the permitting and development process. You can't change the fact that most silver comes as a byproduct of other mining operations. This is the setup for a squeeze that could make previous silver rallies look modest by comparison. Not because of speculation or manipulation, but because of genuine fundamental supply-demand imbalances driven by the real economy. And here's the final piece that ties it all together. In a world of increasing uncertainty, geopolitical tensions, monetary instability, technological disruption, silver represents something tangible and real. It's a metal that's been valued for thousands of years, that's critical to modern technology, and that can't be printed or digitally created. When you hold physical silver, you're holding something that has intrinsic value independent of any government or financial institution. In an era where trust in institutions is declining and systemic risks are rising, that's a powerful attribute. The silver squeeze that's unfolding globally is not just a market phenomenon. It's a reflection of deeper changes in how the world economy functions. The transition to renewable energy, the electrification of transportation, the digitalization of everything. These are not temporary trends. They're fundamental shifts that will define the coming decades. And silver sits at the heart of all of them. It's the metal that makes these transitions possible. Without silver, the solar panels don't work efficiently. The electric vehicles don't perform as well. The electronics don't function properly. It's irreplaceable in countless applications. So when we talk about a silver squeeze going global, we're really talking about the world waking up to the fact that this metal is far more critical and far more scarce than most people realized. We're talking about a repricing of silver to reflect its true importance in the modern economy. The question you have to ask yourself is this: do you want to be positioned before that repricing happens, or do you want to watch it happen and wish you had acted sooner? Because once the squeeze is obvious to everyone, the opportunity to get in at reasonable prices is gone. The fundamentals are clear. The supply deficit is real and growing. The demand drivers are accelerating. The global nature of the squeeze means there's no escape valve, no single source of supply that can flood the market and relieve the pressure. This is the setup. The pieces are in place, and the clock is ticking. The silver squeeze has gone global, and what happens next could reshape the precious metals market for years to come. The only question is whether you'll be positioned to benefit from it or watching from the sidelines wishing you had paid attention to the warning signs.